do you recommend consolidating student loans if you're in the process of repayment?
It depends. No? So it totally depends, and this is probably something that you hear a lot from people in personal finance, but everything is, everything is so personal. And when I say it's so personal, it means I would have to look at your different loans and your different rates to say if it's a good idea to consolidate or not. But here's the thing about consolidation is unless you're consolidating loans with a lender that's then going to report to the credit bureaus that there's a debt consolidation, then it's not going to impact your credit. Basically, what's going to happen is you're going to take all of these loans at all these different rates with all these different loan numbers and blah, blah, blah. I mean, I had a client who had 9 different student loans. And it's yes. I mean, yeah, you can put those on auto payment.
Sure.
But it's a lot to manage. So, But what happens when you consolidate loans is that you roll your higher interest rate loans into they're going to meet you in the middle. So if you've got loans at 5% and you've got loans at 6%, they're probably going to give you 5.5%.
Okay.
So the only impact that you've made is that you've reduced your 9 payments now into 1 for a medium interest rate. And that could be really good for someone. I mean,
sure.
If that helps you manage your personal finances, then why not?
Yeah. So, so it's not all over the place and things like that you're paying. Because I know I'm currently dealing with that too, and it's oh my gosh, I have Sally Mae, I have Great Lakes, I have, Perkins,
Yes, and thank you for saying that, because it's also important to know what benefits you have on each of these student loans, because for the federal loans, once you consolidate those out of the federal loan, let's say you consolidate it into a private loan, you lose all of those benefits. Loan forgiveness, forbearance, deferment, and those benefits are good. You want to keep them because for me, it's kind of like the difference between a 30-year mortgage and a 15-year mortgage. You never want to pigeonhole yourself into something that you have to do. For example, if you consolidate all of your federal loans and you lose those benefits and they're in a private student loan, then you don't have the option anymore to defer your payment. And there might be a time when you need to do that.
Right.
And it's the same thing with the 30-year versus the 15-year mortgage. Yes, with a shorter mortgage, it's a shorter term, you pay less interest. We know that. When it comes to loans, shorter term equals less interest.
Right.
But you're also committing yourself to 15 years of much higher payments.
Sure.
Much higher payments. Yes, in the end, you're going to pay less interest. Good. But what if you lose your job?
Sure.
And you're in the process of debt elimination? Okay, so you're eliminating your debt. You're in a 15-year mortgage. You have no savings or just a teeny bit of savings. What are you going to fall back on? So I would say get the same benefit from the 15-year mortgage with a 30-year mortgage. If you have the cash flow to pay that 30-year mortgage to make that 15-year payment, then do that. And then you get the extra bonus of the lower interest rate by making 1 additional mortgage payment a year.